Welcome to the weekly update, where I'll go over the action in the market for the week of November 27th through December 1st, and then we'll see how things look for the week of December 4th through the 8th. We had another up week, not really strong. We were up a little more than 0.25% on the week, but it's helping our technical picture to show some improvement. But as always, there are some warning signs. Nothing is ever completely black or white or cut and dry. Even when the market's going higher and higher and higher, there are still things that we need to be concerned about and be aware of. But yet, the way I approach things is I take everything all together to reach an overall consensus conclusion. And so this is part of that overall puzzle. Before I get started, please note that I do load up a PDF for each video that I record and I upload, whether it's to YouTube or Rumble. Some folks have found this valuable to be able to download. They can read through the exact words that you're seeing right now. You can also look at the charts. Sometimes you can look at it on a bigger screen. It might give you some insight that you're not necessarily getting by just watching the video itself. So it's meant to be a tool for you to be able to use. Also, every day I update the pivot points. This is only on the YouTube community channel, where we have pivot points that last for the whole month. And then we have pivot points that adjust each day. And so every day you can look at those. I found the intraday pivot points to be very helpful. And there's even a chart that I'll show you later where the weekly pivot points, that was the exact top that we hit last summer. And we still have not been able to get back to that level. Also, I do have a private Facebook group. Not an awful lot of back and forth going on, but if you would like to join that, you're more than welcome to do so. Just send me a request and I'll be happy to have you join the group. And if you want to voice some things, share some information, maybe something that you're reading or research that you're doing, that's what the group is all about. I already posted the poll, believe it or not. I had a little time before I was able to record. And so I'll be going through the results of the week that we just finished, and there's a new poll that's already been posted for the upcoming week. I do keep a real close watch on comments, and this not only applies to YouTube, it also applies to Rumble. I get a lot of crap comments and a lot of just spam comments and bot comments. If I do see those, I try to get rid of those just as quick as possible. And I also post these same videos on Rumble. So if that's your main platform and you can't find me for some reason, you might want to jump over to YouTube. If you can't find me on YouTube, you can always jump over to Rumble. Here is a link to that channel, and also it's in the description below each video. Let's go back and talk about what happened for the week. So for the week, we were up 0.77%, not real gangbuster, but with a market that was already overextended a week ago, the fact that we were even able to close up is kind of positive. And we're not seeing a lot of selling into strength, at least yet. We did finally get back to the point where we're above average with volume. Now, last week was different. We had Thanksgiving. We had a holiday shortened week. A lot of folks ended up taking the whole week off. Then we followed that up with some real low volume days. Well, now we're starting to see that pick up again. We are positive with the technicals. There are some things, as I said, that we need to be concerned about, but when we take everything all together, we're looking pretty good and showing improvement right now on the weekly charts. But at the same time, in the short and intermediate term on the daily charts, we are overextended to the upside. You could make a case that we're overbought, but we've been overbought for well over a week now, and we haven't seen a really solid pullback, at least anything really substantial. Now, there are times when the market can work off these conditions by basically going sideways. We don't know if that's what's going to happen. We have periods of weak seasonality that could play into this. There are mutual funds who are doing their distributions and shoring up things before the end of the year. That sometimes means they have to come in and sell. That can have a real impact on the market when you have a big mutual fund that comes in and either buys or sells. We're keeping an eye on inflation, interest rates, and growth concerns, and then any word that we're getting out of the Fed. They're more middle of the road right now. There are some Fed governors saying, well, if we see continued weakness in the economy, they haven't said the cut word yet, but they're still going with the idea that rates are going to be higher for longer. But as Jerome Powell said this past week, if things get stronger, we might have to raise rates. Now, The market is still liking the idea that we're not too hot, not too cold with the economy. As long as we don't get really extreme in one direction or the other, you may not be having a really good time economically, and a lot of people are not right now, but at least the market is comfortable with where things are at for the time being. Our trend is still weakening. We have the ADX dropping below 20 on the weekly chart. We've switched over to positive on the daily charts, but we're looking overextended, giving a very high reading in the short term, and we're still strong in the intermediate term, where things are still shifting in the longer term weekly charts. So for the week, the Dow was up 2.4%. The NASDAQ was up 0.4%. Kind of interesting here. It was a lot of the mega caps that didn't do as well this week. We're seeing more broad market participation, especially when you look down to the Russell 2000 small caps. They were up the most at 3.1%. Now, we're coming into this Santa Claus rally you want to talk about, or this gracious time for the stock market. And the research that I've looked at does suggest that about from the middle of December, well off into the beginning of the new year, historically, this can be a positive time for small caps. Now, it doesn't mean it's going to happen this time, but this is what has happened in the past, where for the S&P, we were up 0.8%. So for the week, Friday's close marked a new 52-week high for the S&P 500. We are just slightly under the 4,600 level. That acted as overhead resistance in Friday's session. We were just within a less than a point away from 4,600 before we stalled out and started to come back. The mega caps did underperform when we take everything all together for the week, where the broad market is showing some strength. In some areas that had been weak are showing a little bit more buying enthusiasm. We're seeing volume picking back up, and this can help the overall market. But it's really the mega caps that drive the S&P 500, as well as the NASDAQ 100, and even to a degree, the Dow. Are we dealing with FOMO? Now, this is an acronym for the fear of missing out. A lot of people, when we were going down a few weeks back, people were just convinced that we were going to go lower, lower, lower. And so they didn't really pay attention to really buying anything. And now we've shot up and we're going and testing previous highs set earlier in the year. And all of a sudden they're like, wait a minute, I'm missing out here. I want to get involved in this. Well, when FOMO kicks in and it really starts leading the market, that's when we're pretty much near a top. And we watch a lot of our sentiment indicators, the VIX and different surveys and studies that we show. And I mainly go through those in the daily videos to try to get a real gauge on, okay, are we getting too extreme positive, or are we still in a more neutral area where we can still go with this idea that things are moving up for right now, but when we get too exuberant, then that's when we want to look at taking on a contrarian type of attitude. Interest rates and the dollar were down on the week, and that has helped give some support to stocks. Some Fed officials, they came out, it's the Federal Open Mouth Committee here, and they just love their time on camera. And so they come out and they make their little statements. And some of them, they really resisted the idea of any rate cuts occurring in the first half of 2024. That's one of the poll questions that I'm asking. Do you think rates are going to be cut in 2024, which I'm kind of going right now up until about maybe spring or so? Economic data that came out, it continued to look really consistent with this idea that we may end up hitting a soft landing. Yes, we're seeing economic slowdown. Yes, some areas are really suffering right now, but we're not necessarily going to go into a recession. And if we can have economic weakness without going into a recession, and then at some point start to see the economy coming back, where if you look at GDP, we're already doing pretty good. If you look at the employment situation, we're doing pretty good. But there are other areas that still are showing some weakness. If we can work through those areas, we may end up getting a soft landing. Earnings were mostly taken as positive. It's a case-by-case basis with this. And just like with NVIDIA, they came out with this killer report, great look into the future, and their stock just tanked after that because you have some of this buy the rumors, sell the news going on, and you have to always be careful about that. And then OPEC came out and said that they're making voluntary cuts that'll start at the beginning of the year. and this will last through the end of March. Actually, oil fell in Friday's session. Usually when some kind of news like this comes out, oil ends up going up. That was not the case. We are keeping an eye on the VIX, and I go through this in each daily video where I have a circle here where it looks like we're kind of at right now, where we might get a little choppy with the VIX. When the VIX is going down, that means stocks are going up. When the VIX is going up, that usually means stocks are going down. Before we start to head lower with the VIX and we head into more the middle part of December, where we see some more positive seasonality, and sometimes at the end of the year, we can see a little bit of selling. People are getting rid of some things that didn't do so well before the end of the calendar year. We're also keeping an eye on inflation. I haven't updated this chart since the end of June, but really what we're following is the blue line here, where it looked like with the gold line, that's kind of where inflation's been headed, where we do still see a decrease in inflation during this period. Now, if we stick to this pattern, that could be trouble going out into the future, because look at this blue line. It really goes up like it did in the mid to late 70s. We don't know if it'll play out that way. We just use this as a guide to kind of give us an idea of what's already happened and compare it to what's going on right now. We are dropping with the 10-year yield. We're down to 4.23%, but we're still above that 4.02%, where according to Renmac, that starts biting into corporate profits. But we were just dealing with 5% just a few weeks back, and now to drop over 0.75%, at least on an intraday basis, that is really showing how interest rates have been declining. Here's the poll results. As of Friday, December 1st, the first question that I asked here, season out, and I asked this question again in the poll. I'm repeating some of the questions here, so I want to kind of get an idea if this changes over a period of time. For the rest of 2023, we are positive historically, and we have positive patterns. Doesn't mean we go straight up. We have some bumpy road along the way, but for the most part, this tends to be a positive time of the year. Do you feel that we're going to follow that pattern, or are we going to end up deviating from that pattern? In the latest reading, we had 78% said that we're going to follow historical norms, and if we do deviate from that, it will be lower. The reason for the middle question is, if we go up, but then we go way above what historically has happened, I wanted to allow for that in this question. Then many of the indicators are starting to show some weakness. And I've been trying to point this out in the daily videos, that some of that may be caused by the way they are calculated. It also can mean that we are overextended to the upside, and we are looking for some kind of a pullback, if not a downright reversal. As of a week ago, what do you think this means? 11% think that it's caused by calculation, which can also suggest a pullback or a reversal, because a lot of times this ends up being a self-fulfilling prophecy, where 78% think that it was due to exhaustion and 11% think that we will actually have a reversal. As of right now, we've still been going higher, and we're getting more to the upside. After the holiday weekend, that was Thanksgiving, it's likely the volume will increase. And so my question was, if volume increases, is that going to be to buy or to sell? 38% thought that it would be buying, which is kind of what ended up happening, where 62% thought that that would lead to selling. And then longer term, this is another question that I'm repeating in the current poll after this. Longer term, the S&P 500 remains below a weekly trend line, and we're still below that trend line right now. Do you think we're going to get above that trend line before the end of the year? Above 53%, below 47%. And the first question and the last question, these are the ones that I'm going to be repeating for the next few weeks, just to see if there's any real change in how folks are answering this. Looking at some Isabel Net blog charts here, it's still showing across the board that earnings going out into the future are showing positive growth. And that is why the stock market is having a tendency to go up. Even when we're going down, that helps these numbers to get even better, because they're being calculated based on lower price levels. But as long as the projections looking out are positive, that's justifying whenever we do start going back up for people to buy even more. Then we did have the ISM manufacturing coming out, and we're trying to see this in relation to the S&P 500 on a year-over-year basis, where we're getting kind of far apart here. The purple line is the S&P year over year, or the gold line is the ISM manufacturing index, where they're kind of far apart from each other, where typically they tend to go in the same direction and they tend to not get all that far apart from each other. Again, even though they're on different scales, what's going to give? Are we going to see ISM manufacturing improve, or are we going to see the purple line, which is the S&P, start to come down for these lines to line up more like they historically do? Just one post from FactSet. It just says that have industry analysts overestimated the S&P 500 earnings per share for 2024. Way over on the right-hand side, this is what they're projecting, and this is what they have been projecting. Now, this isn't real yet because that's the blue area here. And you can see that there are times when analysts over or underestimate what earnings will be, but overall, we're seeing this going up, and that's justifying higher stock prices. And we'll have to just see how this plays out going forward, because these are just estimates as of right now. But when I go through the intermarket analysis video, I talk about valuation, and this plays into that overall calculation. Getting into our charts, here's the intraday chart, where on Monday we were pretty much flat. It was a real yawner, although it was exciting compared to the Friday after Thanksgiving. Then we started to see a gap lower on Tuesday, but then we broke above that and actually showed some strength. Things were looking a little better, but then we gave it all back and ended up not having all that positive of a day. Then on Wednesday, we gapped higher and then ended up going lower. Really choppy. You can see these candles in here. They're really long, meaning there's a lot of buying and selling going on at these different price levels, where we ended up going lower and then finishing higher after the Thursday session. Where we saw the gains on the week really was in Friday's session, where we did have a little bit of a higher open above the daily pivot, and then we were able to break above R1, R2. Right here is 4,600. We came down from that and we closed a little bit above R2. So for the week, all of the indexes ended up being positive, with the small caps, believe it or not, they came in first place, followed by the mid caps. These have been weaker areas in the market. The Dow had a pretty good week, where you have the S&P, the NASDAQ, and NASDAQ 100. These are the mega caps. They really didn't have as good of a week. Now, please be reminded that these are just the 5 trading days. It's not Friday to Friday. This is Monday through Friday when I run this particular bar chart. So when we go back to the beginning of the year, all of the indexes are positive, with the NASDAQ 100 and the NASDAQ and the S&P doing the best. But all of the other indexes right now are positive on the year. All of the indexes are negative when we go back to the all-time high. We're still underneath that. We're inching our way closer. Right now, we're 4.15% away from the S&P. We're 1.5% away from the Dow. We're 1.37% when we look at the NASDAQ 100. It's the small caps here and the mid caps and the NASDAQ itself. They are still underwater and still have a lot of repairing to do. Looking at the sectors, we had an up week, so that's the way I sorted this. And you'll notice real estate, that's been a hammered area in 2023. It did the best. Industrials have been in a downtrend lately. They showed a little bit of improvement. Discretionary has been a stronger area, but it's been chopping sideways. We need to see more follow through with discretionary. That's more of the growth area where you want to buy low and sell high. Utilities have been quite weak. They actually had a pretty good week. All of the sectors ended up being positive. But if you notice, tech and communication, the two strongest areas in 2023, they were finishing at the bottom of the board this past week. Then looking at our relative rotation graph, where the upper right-hand corner, that's the plus plus. Those are the strong areas, where energy was doing really well, and now it's turning yellow, and it's starting to get into the weaker area, where we're seeing financials. Yes, financials have actually been bouncing back a little bit lately. And then we also have tech, XLK, right here, and we have communication, XLC. These are the two stronger areas, and they're still hanging in there. We are seeing some improvement with the utilities, staples, and real estate, also followed by healthcare. But we have industrials and discretionary down here. They're actually turning weaker. We've been watching that for a while. They were stronger earlier in the year. Now they're starting to show some weakness. For the market to turn more positive, we want to see XLY, which is the discretionary sector, start to show some real improvement. And we're not seeing that yet. When we look at all the different sectors for the week, this is just the 5 trading days. Real estate, materials, industrials, and financials. These are the harder hit areas in 2023. They did the best. Where we have communication, energy ended up being down, and tech was also down on the week. Going back to the beginning of the year, the 3 strongest areas are tech, communication, and discretionary. All of the other sectors, even though they're showing some improvement, continue to be negative on the year. Going back to the all-time high, we have energy, which has given up a lot of its gains, but it's still doing very well, followed by tech and industrials, where the rest of the sectors are still negative. But we're inching our way closer back to that all-time high. We don't know if we're going to actually get there. If it's going to happen, it might happen in the next month or so because we have real positive seasonality that's happening. But that's just an average. We don't know if it's actually going to play out that way. Keeping an eye on sentiment, we are at 67 right now. And what's more helpful is when we look at the chart, we're not at 75 yet. So when this is going up, we can go with it. There are some folks that always want to do the opposite of what this chart is doing. That's not the way I look at it. When we get down below 25, people are very pessimistic at that point, and we're looking to be contrarian. Well, when we get up to 75, that's when people are really exuberant about things. And now we're looking at being contrarian at that point. But from the time we go from the bottom up to the top, we can go with that because that's the general trend of the market. The active asset managers are showing some improvement. They're not necessarily extreme as of the latest reading. Here's another look at that same chart with getting a reading of 81.38. It's when they get above 90. That's when they start to get extreme, even though they can even go above 90. Then looking at the VIX, we're just showing not an awful lot of fear in the market right now. The line chart's going down and the bar chart is really going down. The Ulster Index, another fear gauge that we look at, we're pegged at the bottom on the daily chart where we're still going sideways above the moving average on the weekly chart. The right-X bear bull ratio, since we've been going up, these folks tend to follow what's already happened. When this is really going down, they're more bullish on the market. When this spikes up, they are more bearish on the market. We're getting close to an extreme reading with the American Association of Individual Investors, but we're not quite there yet. We're just underneath this pink line here. When we get above the 30 level, and especially when we get above the 40 level, that's when everybody thinks the party is never going to stop, and that's when we look at being a contrarian. This is another, I use this as a sentiment gauge. How would you do if you had, let's say, $100 and you kept that in your pocket, which is the 1 to 3 month T-bills, basically cash, or if you put that $100 into the tech sector, which one would do better? Well, this black line going down means that the tech sector is outperforming cash. It did run into some problems in 2022, but it's continuing to decline in 2023, meaning that the tech sector is outperforming cash. Some economic charts to show you. We did have another reading of the GDP estimate, the second reading, where the Atlanta Now forecast has really started to come down. We're still positive. We're above 1%, but it really dropped off. And this is for the fourth quarter now, where if you look at the different forecasts out there, on the top, we're at about 1 3/4, and on the bottom, we're at about probably about 3/4 there. And you can see this is really narrowing up now as we had another estimate for GDP. We're not as wide with the forecasts. Here's what it looks like on the bar chart. The important thing to take away from this, at least that I take away from it, is that we are still positive. We're not seeing negative GDP. If we see that for 2 consecutive quarters, that's one of the parts of being in a recession. We look at the spread between risky and not as risky bonds. This is going down. If we were concerned, this ratio would be going up. And then some of these haven't been updated. This one has. These are the National Financial Conditions Index. We're actually going down here. When we get concerned is when we go above the black line. This hasn't been updated for a few weeks now. These are the tightening conditions, or the tightening standards, I should say. When you go to a bank and try to apply for a loan, when this is going down, that means they're lessening their rules. When this is going up, that means they're getting tighter with their rules. This hasn't been updated since November 14th, where we're above the black line, but we're not up to the red line with the real-time SOM recession rule indicator. I think I read that wrong. This I actually got from IsabelNet because the Fed site isn't updating. This was updated as of November 30th, where we're above the black line. But when we get concerned with this is when we get up to the red line, and we're not there yet. If we do really start to climb up, other times when that happened, that typically mark these gray areas, which is a recession. And then looking at the Brave Butters Kelly index, hasn't been updated since the end of October. So we had been coming down slightly. This had been going up, which was giving us some concern. And as I always say with these charts, they're great for telling us what we should have done 6 months ago, because these charts are just not updated in a very timely manner. And so we can't use them to make decisions. This is more for information. And it's like, oh yeah, maybe I should have bought or sold 6 months ago. See, that doesn't do us much of any good. Keeping an eye on inflation, we are dropping down a little bit here with CPI, as well as the PCE inflation. But when we look at the headline numbers for both of those reports, they continue to be pretty much flat. We dropped a little bit with the core PCE inflation since we had a report this past week. Where are we with the Fed? There's a 98.8% chance that on the December 13th meeting, the Fed is going to keep rates unchanged. This is how it has transpired historically. The blue area is where we're at now, and then a day before, a week ago, and a month ago. And more folks are getting more comfortable with the idea that the rates are not going to be raised at the next meeting. Looking at the Fed balance sheet, it is continuing to decline, just as the Fed said it should. Here's where we look at the year-over-year change. It actually looks like it's turning up, but you need to look up here with the negative -788 number. That shows that the Fed balance sheet's going down. Looking at the advanced decline line on the weekly chart, we are looking positive based on price and volume and showing improvement. We're seeing a real expansion of new highs and not really any new lows. So our 4-week is going up and our 10-week is also going up. That is showing more internal strength. The advanced decline ratio, we're getting a little toppy here on the daily chart with the blue line, but we're still looking more positive with the weekly chart. Accumulation distribution, this tries to measure the smart money. We're above the moving average. We're also above the moving average on the daily chart. Keeping an eye on our trend where the ADX is ever so slightly trying to turn up, but it's still below its moving average, and it's also below 20, but the green line's on top. So we are now in a trendless environment as far as the week goes. You wouldn't really know that by looking at these bars that keep going higher, but this is just the measurement that we use to try to determine, are we trending and how strong is that trend? If we see another week or two of positive action, this could actually turn and start to go up. But we do default to the positive side because the green line is on top and the red line's declining. The Erin indicator really hasn't changed all that much. It is still negative, where it's actually looking almost extreme positive on the daily charts. The mass index is not generating a signal. The daily chart, where we came right up to this red line that's been here for a long time, this goes back right near the previous high that we set back in July 31st. And we have not been able to close above that yet. And this is just a little bit above the 4,600 level. Then you can see the last few days, we have been above average with volume. We are above the midpoint of the trend channel and getting a little further away from that as things turn more positive. This is the pivot point based on monthly chart or weekly charts that actually last for the whole month, where we hit this pivot point right here on July 31st or the week of that. And then we started falling back down. Now we're coming back and starting to flirt around with this. Is this going to provide some kind of overhead resistance? Or are we going to be able to break on through to the other side, as Jim Morrison would say? All right, when we look at our trend, the 50-period simple moving average, the run line's going up and we're above the moving average and looking better. The long-term trend for the S&P is now gone back to looking more decisively positive. We are a little extreme with the McClellan oscillator, but we could still go higher. And if you hear a dog barking in the background, I apologize for that. Not for the dog, but I try to do this when things are quiet. When we look at the summation index based on price, we're above zero and advancing. We're advancing based on volume. We're getting close, but we're not getting an extreme reading based on volume. The Swenlin trading oscillator, we actually turned down just a little bit based on price and volume, but we're above zero, so we're also positive. The bullish percent index almost seeing this exact same thing on the daily chart. And this is still looking healthy. We're above 50 and advancing and not getting an extreme positive reading. The PMO, which is a momentum oscillator, starting to turn back up. We're also looking more positive based on price and volume. When we look at our PMO studies, we're getting extreme with the PMOs that are rising. We're turning down, but still extreme with the buy signals. We're going up with the PMOs that are above zero and not quite extreme yet. And we're seeing almost the same thing on the daily study that we look at. The percent B indicator measures when we go outside the either the upper or lower Bollinger Band. We're not there right now, but when we're above the midpoint and going up, that shows things are more positive. Here are our weekly oscillators. We're turning back up at the slope where we're actually coming down on the daily chart after getting really extreme, turning back up with the TSI. Both of these are shorter term. Then we drop into the intermediate term where the MACD, the PMO, and the PPO are showing improvement. The TRIX and the KST, which are our long-term oscillators, they're turning back up, but they haven't crossed over positive yet. The Chaikin money flow, another smart money indicator, still negative, but showing some improvement. We were getting a really high reading on the daily chart, and it's actually starting to come back down. The Chaikin oscillator is above zero and advancing. That's positive. The force index is green and above zero. That's positive. The money flow indicator is above 50 and advancing. That's positive. We had an up week, so I just go the rate of change from 1 week to the next. When we're above the zero line, that means we had a positive week. Going back 50 weeks, you could make a case that maybe we're getting a little extreme here, but we can break higher than that. There have been times when we've broken well above this. These red lines I put on here just as kind of guidelines, so we shouldn't really take this as any kind of gospel truth if we end up going above this line. The RSI based on 14 weeks is above 50 and advancing. That's positive. The weekly special K chart is negative, where the daily special K chart is positive. The Stochh RSI is extreme positive. The Williams percent R is also extreme positive. The ultimate oscillator is above 50 and advancing. That's positive. The Vortex has the green line above the red line. That's more positive. The Copic curve, we just generated a sell signal with the Copic curve, where now we're seeing more of a longer-term buy signal on the weekly chart. And looking at our different support levels here, we're well above all the moving averages. We're well above the Fibonacci retracements, and we're well above this 200-week moving average. And you can see we're coming back and flirting with this previous high again. Our different charts, when we look at the Heikin Ashi, we have open candles. That's positive. The Kegi chart is positive with a black bar pointing up. The Renko is positive with open blocks. The 3-line break is positive. The ease of movement, really, there are two different things that I show on this chart. The top part of this chart is equivolume. When it's green, that's positive. The thicker the bar, that means more volume went into that move. There's a little bit of a concern here. This was Thanksgiving where we had a green bar, but it was a very thin green bar. When we look at the 14-week, we've crossed back above zero and we're turning more positive. Nothing new was generated on the point and figure chart this week. We are still looking more positive. The last signal that was generated was on November 20th, which is a double top breakout. We are looking positive with the Elder Impulse system for the S&P on the weekly chart. We've been chopping around neutral for many, many days. We're seeing lots of blue bars on the daily charts with many different indexes. The parabolic SAR system is positive because the dots are underneath, and we're confirmed with that on the daily charts. The PPO study, we're turning up in the long term, showing some improvement in the intermediate term. We actually declined, but we're still positive in the short term. Then I go through the last daily video that I did for Monday's session, and I just pick out some daily charts that might be interesting. This is a warning sign. This is the growth to value ratio for the S&P 500 daily chart. When this is going down, we want to see this going up. And the fact that the S&P has been going up as this has been going down, that's a bit of a concern to us. We also look at the ratio between small cap growth and small cap value. Small caps were up huge in Friday's session, but this ratio declined. We have been chopping more or less sideways. As the index had been coming down, this ratio was holding up. But now that we're starting to go back up, we're not seeing a lot of strength in this ratio. And the mid caps, which have been hanging in there, even though the index was going down, we actually declined in Friday's session. And you can see the bar up here. Most of this gain was from Friday's session. Then we look at discretionary equal weight, where it is showing some improvement, but it's still in a downtrend. Staples showing some improvement, also in a downtrend. When we take a ratio between the two, we are breaking out just a little bit, but we want to see this continue to go higher. Here is the short-term ADX, and we're getting above 40 now. And this could suggest that we're getting exhausted. We're not seeing that in the intermediate term chart, on the intermediate term chart for right now, because this is shorter term. So we would see this signal first, but we still default to the positive because the green line's on top. Now, this could go higher. It went higher than this before, but look at other times when we maxed out, we saw a bit of a pullback here. And then when we maxed out again, this is when we saw a pretty hefty decline after that. So we'll just have to watch things to see how this plays out. Here's our trend line study. We're above all the trend lines that we've been following here. What we're watching right now is this previous high. We've been able to get above that. Are we going to give a run to this other high that was set earlier in the year to see if we can break through that? The transports had a good day on Friday compared to the S&P. They were really up, but we want to see this continue to go up. If this starts to go down, that's another warning sign for us. And we're still dealing with this all-time high with the FANG index. We're not able to close above this, but we're still looking pretty good, even though we were actually down in Friday's session. This is a study that's longer term, where we take the new highs minus the new lows and then a 50-period exponential moving average of that. We had dropped below zero. Now we've crossed back above zero. That's positive. Then looking at the broad market, this is seasonality from 2019 through 2023 thus far. Now we're into the month of December, where it's up 80% of the time, with the average return being 1.1%. Just to let you know, we were up in November with a return of 5.5%, according to this chart. Looking at just a straight index study here with the S&P on top looking better, the mid caps are showing some improvement, but where we're dealing with this previous high with the S&P, we're still well below it with the mid caps and the small caps. That's a little bit of a concern. Where the Dow continues to be in an uptrend and had a really good week. The NASDAQ is also in an uptrend. The NASDAQ 100 is in an uptrend. The mid caps are still in a downtrend. If we can stay above these moving averages, that could turn us back into a golden cross. The small caps also in a downtrend, but had a really good day on Friday. We need to see some improvement there. The NYSE trying to work off of this recent death cross. We've spent a few weeks above both of these moving averages. We could generate a golden cross fairly soon. All stocks continue to be in an uptrend. And the 30 biggest software companies also gave us a recent death cross. We're back above the moving averages. Another week or two of positive price action, and we could generate a golden cross. The FANG index, which has been doing quite well, it was pretty much a non-event in Friday's session. We're still dealing with this previous all-time high here, but we are longer term still in an uptrend. We're also in an uptrend on the daily chart. ARC, which is trying to give us another golden cross here. It was up almost 8% on the week. So that's showing some improvement. The bank index, we're seeing a little bit of an improvement with the financials, but when we look at the bank index, the momentum is positive. It had a good week, and the RSI is above 50. The deposits that are either going into or coming out of commercial banks, I know it looks like this is going up, so we look at the number here, where it's at minus 399. Looking at just a blank chart of Dow theory. Now, traditional Dow theory just looks at the Dow and the transports. Where the Dow's been breaking out, we're not breaking out with the transports here. We're actually surpassing this previous high. We haven't even come back up to the previous high with the transports. For things to turn more positive, we want to see the transports, okay, here's a pun, kick into gear. Ha, 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 ha. We are seeing a little bit of an improvement with the utilities, but as interest rates were going up, they were really going down. Now that interest rates have been falling, we're seeing the utilities show some improvement. Looking at other markets, this is a weekly chart of the CRB index, where it is down again on the week, but it's still in a longer uptrend. Oil is back down. We almost hit 95. Now we're a bit over 74. Copper still in a downtrend, but showing a little bit of an improvement as these economic reports have been coming out. The dollar is still in a longer-term uptrend, but we've been seeing some weakness on the daily chart and here on the weekly chart. Gold is trying to break out here. If you look at other gold measurements, we've already broken above 2,000. Where here we have a series of previous highs that we need to break above for this to look better. We are coming back to showing a longer-term uptrend. Silver is still in a downtrend, but also has been showing some improvement. Looking at bonds, we're based on price. We're still in a downtrend, but it has been bouncing back up. The stock to bond ratio on a monthly chart is rolling over just a little bit, but stocks are continuing to outperform bonds. This is an anomaly that I've been pointing out on the daily charts, where when we take the 1 month yield and subtract the 3 month yield, we should always get a negative answer. We've been climbing over the last few days and we're at a plus 0.12 for right now. Is the market picking up some kind of weirdness that isn't necessarily following through to price? Here are the yields, which we look at all the different yields that have been declining overall. Here's a weekly chart looking internationally with the US and UK rates being the highest. German rates are the blue line, but it has been declining, where even Japanese rates, which are the lowest, they have been declining. Some relative studies. First, we look at an intermarket analysis chart going back to the beginning of the year. Stocks are doing the best, followed by gold, the dollar, and now energy has turned negative, where bonds are showing some improvement, but they're still down on the year. Going back to the beginning of 2022, oil is still in the lead, followed by the dollar, and then gold, where stocks and bonds are improving, but still negative. The NASDAQ 100 to S&P 500 ratio shows that the NASDAQ 100 is outperforming. The S&P 100 is actually pulling back a little bit compared to the S&P 500, but it's still in a longer-term uptrend. Growth is still outperforming value, even though it has been showing some weakness. And the gold to S&P 500 ratio, as gold has been seeing some strength, this ratio is starting to turn back up. And when we look at the gold to the dollar ratio, this is actually breaking above this red trend line, which we've been watching now for quite a while. Are we going to run into some overhead resistance if we try to hit this blue downward sloping trend line? Bonds continue to underperform stocks on a shorter term chart. The low volatility ratio with the S&P 500, we did see a little bit of a tick up, but the low volatility stocks have really been underperforming in 2023. Discretionary continues to be positive when compared to staples, and energy is underperforming when compared to tech. Then some of our long-term studies. We are still working off of a signal that was generated on October 2022, so over a year ago now, and this is indefinitely on the books and a longer-term positive buy signal, where we had 2 ZWAG NYSE breadth thrusts triggered. We rarely see any of these signals, and now we've had 2 within a year. We had one last March, and then we had one right near the end of October going into the early part of November. This is longer term positive. So when I talk about in the daily videos, positive seasonality and setups, the previous chart, the NYSE breadth thrust and the ZWAG NYSE breadth thrust, that's what I'm talking about. This is giving us a little bit of a concern. We had been seeing a buy signal with the Zohorchak, then it dropped down to 4. Now it's dropped down to -6. If we drop all the way to -10, that's a full-on sell signal. If we do see some positive action, we're going to look to see if this chart shows an improvement. Longer term, going back to the 1987 crash, we're still coming right up to the underside of this trend line. Here's a bigger blow up of that same trend line. We are showing improvement here, but we have not been able to get above this weekly trend line. The NASDAQ 100 also may have come right up to this trend line and is starting to turn back down. Is that going to be a problem? The ratio from the NASDAQ 100 to the Dow, it never did really get back to this previous high here. If this really starts to fall, that's going to cause us to turn more negative on the market. We also actually exceeded this high when we look at the QQQs, which is the NASDAQ 100, and take a ratio of that with the IWM, which is the Russell 2000 small cap index. This going down, yeah, it's a little bit of a concern. We want to see this going up, but we're also getting back to a really high reading. When we look at the cumulative new highs, new lows for the NASDAQ, for many years now, they've been declining. However, we remain above the midpoint here. The longer we can stay above this and even start to go up, maybe eventually we'll see this cumulative line start to turn back up as well. We are starting to roll over with the 3-month yield. We don't know if that's relevant or not. Back in 2007, that's what we saw, and we went into the great financial crisis. We just kept going up and up and up here, and now we're starting to come back down. If this continues to fall, will that give us a warning sign? And I apologize again for the dog if you hear him. I don't have the latest chart from Tom Bowley. I just have the November one here now. I'll just have to wait until I get that in the email. So this is just based on Monday's session, based on the daily charts. We're still dealing with earnings season. We're still dealing with geopolitical events. Our technicals are positive, but we continue to be overbought. We're wondering if some weakness is starting to creep in, or is this just the way certain indicators are calculated? We will get factory orders in Monday's session, and then the whole list of geopolitical events with Israel at the top of the list. Here's the upcoming economic calendar. We're going to get ISM non-manufacturing on Tuesday. That's a biggie. The other really big one, and these other ones are important, but we're going to get the big employment situation report this coming Friday. Then I actually have a separate section for seasonality, and I'm trying to expand that to give you as many charts as I can find to see what kind of uniformity we're seeing here, where for the month of December, it tends to be the third best month of the year. And then I also added this, most of the January effect. I think I called it the Santa Claus rally, but this is called the January effect. This takes place in the latter part of December, and this is when the small caps can often outperform. Over the last 72 years, in the month of December, we've been up 75% of the time and down 25% of the time. I won't deal with options expiration yet because we're not there. But just looking at Monday's session, we are negative with the Dow, neutral to negative with the S&P, and neutral to positive with the NASDAQ. So we run the whole gambit there. This is what I try to do at the beginning of each month. These are Stock Traders Almanac statistics that go for the whole year. We have the January barometer. It states that if the January of the beginning of the year, which was up, if it is up, we are up 83.3% of the time going back to 1950. That is what happened. Then we have this thing called the trifecta, and then we have a 1, 2, 3 score here. The first score is almost a year ago. We had a Santa Claus rally. That gave us a score of 1. Then we look at the first 5 trading days in January. That was up, so that gave us a score of 2. Then we look at the whole month of January, and that was up, so that gave us a score of 3. So when all 3 of these indicators are positive, when you go from February looking forward, we're up 87.1% of the time with an average gain of 12.3%. If you take all the 12 months together, we're up 90.3% of the time with an average gain of 17.5%. Also, another positive thing that the market likes is that we are split between Democrat and Republican in Congress. The one thing that I do point out is a lot of legislation is coming from the executive branch these days through executive orders. So that's not necessarily the way the Constitution was designed, but it's what's been the trend over the last few decades. This is looking at a chart of the Russell 2000, which are small caps, and taking a ratio with the Russell 1000 and looking at the seasonal pattern. And the red area is what I'm highlighting here, where in the month of December, the small caps tend to outperform the large caps. Now, is that going to happen? We don't know, but historically, that is what has happened from 1979 up to 2022. We will be on the second trading day of the month on Monday, where we're pretty much flat seasonally. And then this is put out by Carson. It says, remember, Santa tends to come later in December, where according to their research, we might get a little bump at the beginning of December and then go up, and then we see some weakness before we really start to take off later in the month, historically. Then Monday and Friday tend to be the most positive days, according to Carson Research in 2023. Then these are charts that I do show in the daily videos where we might see some weakness as we get into December before we see some strength going into the end of the year. And we're following the green line because this is when a sitting president is running for re-election. Then we have another look at this from 1990 up to 2022, where we chop more or less sideways before we see some more strength. This is another way of looking at seasonality from 1950 up to 2022, where we tend to see positive seasonality here, but we do have points of weakness along the way historically. When we compare an election year with a non-election year, we tend to see more positive seasonality, but then we tend to see some weakness going into the very end of December. Here's another Carson chart where it says the end of the year rally is here, where we see some weakness at the latter part of November to beginning of December before we see more positive seasonality historically. Here's another chart that I ran across a few days ago, put out by Equity Clock, where coming into December, we tend to see an upward move, then we see a fallback, and then we see more positive seasonality going into the latter part of the month. We look at the Stock Traders Almanac statistics for the NASDAQ, where we see nothing really drastic as far as historically showing any declines before we see things moving up a little stronger. So, and the reason why I show all these charts is because I don't use these to make decisions, but when I can gather a lot of different information from different sources, I put that together and just kind of reach a consensus. Because I found that seasonality, rather than projecting out and comparing one year with another year, which we tend to do to a degree, seasonality tends to give us a pretty good guide, but it's only a guide. It's not anything to necessarily use to make decisions. When we look at the S&P, we also see some positive seasonality after some weakness earlier in December. So our scenarios, just for Monday, we're not going with the down scenario, even though we are overbought and there might be some weakness developing. We're still leaning towards the positive scenario, and we're not going with the sideways scenario. Some warning signs, the risk on to risk off ratio that we look at, it's showing a little bit of an improvement, but it's still been declining when you take a bigger look at that chart. Our momentum oscillators, some of them are getting extreme, and the slope oscillator is actually starting to roll over and has crossed below its moving average. The Copic curve has generated a sell signal where we're still dealing with downtrends with the Russell, small caps, and mid caps. The positive signs, the long-term, this is long-term warning signs, okay? The longer-term trend signals may be signaling a top. These are those weekly charts where we're still below those longer-term trend lines. The cumulative and new highs, new lows for the NASDAQ have been showing weakness for a long time now. The 3-month yield, I did show you that chart. We're above where we were at back in 2007, and it's starting to decline. We just want to keep an eye on that. And then earnings season, we kind of have to take on a case-by-case basis. And then the Zoharchak method. We've seen that really drop down. Is it going to turn and go back up, or is it going to generate a sell signal? Then the positive signs. The daily special K chart is positive, or the weekly chart is still negative. And then looking at our equity put call ratio studies, we're positive, which means we're going down in the 5 period and the 253 period study that we look at. We're still looking okay with our S&P 500 and NASDAQ 100 oscillators, but they are rolling over now. The PPO could cross below its moving average if we don't see the NASDAQ 100 really have a good day or two this next week. The parabolic SAR chart and the vortex chart continues to be positive, and the bullish percent index is still climbing and not extreme right now. That's positive. Small and mid cap growth, I showed you those charts. We are chopping more or less sideways, not seeing a lot of strength, but we're not really seeing weakness. Financial sector has been showing some improvement lately, enough to generate a golden cross. And the 50-period exponential moving average study for the new highs, new lows, that is crossing back above zero and looking more positive. Longer term, we did have 2 ZWAG NYSE breadth thrust signals that have been generated. Seasonally and historically, December tends to be the 3rd best month of the year. The longer-term positive seasonality and setups, those are still there. The only one that's in question right now is the Zoharchak method. The S&P is still above the downtrend channel upper line. I'll show that in the deep dive video. So our conclusion just for Monday, but this is where I was at a week ago, and I haven't changed this all week. We are still positive, but overbought. Is weakness starting to develop? We're not seeing that confirmed by price yet, but in the long term, we still continue to be positive because we are above the 200-day simple moving average. Thank you. I hope you found this helpful. Please feel free to check out the daily video, any of the daily videos, and I will be posting the intermarket analysis video and deep dive video over the course of the rest of this weekend. So I hope you have a great weekend. Congratulations to the Washington Huskies. That's my home area. They won the Pac-12 championship. We'll see how things play out from here for some kind of national game. So have a very good weekend, and I will talk to you in the next video.